Welcome back, traders. We're going to go through another ICT lecture today. This one is called NQ Review when 9:30 a.m. Eastern Time is first presented fair value gap, May 18th, 2025. So he's preached about how the earliest time for the first presented fair value gap is 9:31. But we've all seen that sometimes at 9:30, there's a lot of volatility, and when combined with the extended trading hours, 9:30 does have a fair value gap. I assume this video is going to talk about that. It is a long one, so let's get started right away. As always, I have the original video linked in the description.
Welcome back, folks. How are you? All right, so this is a review for week ending May 16th, 2025. All right, so we're looking at the weekly chart here. This is a continuous chart.
Okay, so I'm going to skip the higher time frame analysis here. If you've been keeping up with my market outlooks, you'll know that I've been calling for all-time highs since the beginning of May when price was down here. ICT is saying he has the same bullish bias, looking for all-time highs should we trade above this fair value gap on the weekly chart. And here are the nearby targets that we can aim for. He has 50% of this weekly wick, the upper weekly wick, and he graded the lower half of this upper wick. So this red 0.5 level is actually 25% of this entire wick. Each one of these price levels is 1/8 of the wick. Now, since I'm watching this a month later on June 24th, I'm going to spoil what price did a month later on the NASDAQ continuous contract. So if you don't want spoilers, skip ahead like 15 seconds. So, spoilers. Today on June 24th, NASDAQ made new all-time highs on the continuous contract. It has not made new all-time highs yet on the September contract, but on the continuous contract, both ICT and myself were correct. Now, I'm going to skip the daily chart as well, but I want to point out one thing he says here that differs from my market outlook that I will take away with. In my market outlook, I was saying price could retrace back to this large fair value gap in order to reaccumulate longs. However, ICT does not want to see that. He said, we made a lot of ground here, and if we were bullish and want to see all-time highs, it would be problematic if we were to return back to this fair value gap. He didn't go into details as to why, but my theory is because of premium to discount. If you take the range from, let's say, this high down to this low, this fair value gap is in the upper half of that range or in a premium. When the market is bullish, we can expect retracements in discount like you see here and here. However, when we get to a premium level, we don't really want to see much retracement at all. In fact, we just pretty much want to see the price run for the buy side liquidity. Now remember, he didn't really confirm this. This is my own theory, but I think this is why ICT says it would be problematic if we return to this fair value gap. He goes on to say that if we do return here, price can pretty much just start chopping around like how we have this prolonged consolidation here.
All right, dropping down into a 15-minute time frame. The red level here, obviously you can see that is being carried from the higher time frame charts, so it's going to be in the entire slides until we get to the last few. All right, so you can see how we work those levels here. These are all the quadrant levels in that weekly CIBI, working around the 21,400 level or thereabouts. Now, if you look real close, you can see there is a big sell-side liquidity pool resting around the 21,300 level. That might be an issue if we gap down, for instance, on Sunday's opening. If we gap down, I would look for them to take this low here and maybe even accelerate down into this low here. Okay, but we've already done enough damage down here that if they come down for these and start the reverse, go back higher, that's fine by me. But to go below this low, and we've already unsettled the sell stops over here with that run, made a higher high. So this is the only reasonable sell side liquidity pool raid that I think is useful. But if we go below this one, then we're probably problematic, and we could start seeing accelerations down into this if this gives up the ghost. Okay, so these are just scenarios I'm weighing out before the new week opens. Nobody knows where the new week opening price is going to be. We don't know how it's going to gap higher, or if it's going to gap lower, or if it's going to open unchanged from Friday's settlement price. So speculating on the initial bias isn't 100%, the procedure that I would encourage you to do, because anything can happen. Something can happen somewhere in the world. Bombs are dropping, anything geopolitical, and cause a crazy opening gap that would be completely out of left field, nobody expecting it. So you have to submit yourself to 6 o'clock Eastern time to see where they open price. And then you can start weighing out all your scenarios. But I just gave you both scenarios that would give me, I guess, the narrative I would operate under. If we gap in a lower gap opening, we're looking for that low and that low for the sell side, resting below that. To remain bullish, I don't want to see it below that low. So hopefully it kind of makes it clear. It's not that here's plan A, here's plan B, and whatever happens, I'm going to come back and cheer and say, see how right I am. This is a matter of weighing out what happens at Sunday's opening price. And you have to have a trading plan of how you're going to engage based on how the opening is on Sunday at 6 o'clock and what is pertinent in the market right now. What's available for liquidity. They left the high up here on Thursday. So if you look at that, there's a big pool of liquidity left up here. And they could have baited with this late sell-off before the settlement at 5 o'clock Friday. So we'll see. All right, drop down to a 1 minute chart. Looking at this chart like this, while we're inside of that larger weekly civvy, I want you to take consideration about how I teach first presented fair value gap for the AM session. So during the opening range of 9:30 to 10 o'clock in the morning, as I was teaching the concept, because it's around the model that I'm taught my son Caleb, I gave him very specific rules. So he would have to use the very first presented fair value gap that he could use would be at 9:31 Eastern time. Between 9:31 and 10 o'clock, the very first fair value gap that forms on a 1 minute chart, that is his gap to use. Extend that throughout the day and throughout the week, and you'll see how they're used over and over and over again. I mentioned at the time when I first introduced this concept, I said that he would learn by experience when he could use the 9:30 1 minute fair value gap. It would take some time in looking at certain things. So I'm bringing in that now because I executed on it on Friday. You can watch a video that was posted prior to this one. I want you to consider this candlestick right here. Now, normally, this would be your first presented fair value gap. But there's a criteria that I'm going to show you when and how I use the 931 as the very first presented fair value gap. Now, there's nothing inherently wrong with using this one. If you extend that throughout the day, eventually you'll get something over here in the afternoon, but you're going to discover that it gets real wild in here and it doesn't respect it as much as the level of that 930 1 minute candlestick.
Okay, so before he gets into it, I'll just go over what I'm noticing. First of all, even though he is long-term bullish, he's outlining a short because he's anticipating that we may have a stop hunt below those equal lows. Now for the first presented fair value gap, just before 9:30, we had this spike up, taking the buy side above this high and even the buy side above these highs. Then immediately we had displacement to the downside, creating a change in the state delivery. We have a fair value gap, order block, and a bearish breaker. So a lot of bearish confluences here, but let's hear what he has to say about his criteria.
Right, so take a look in the lower right hand corner. You can see that the chart now is toggled to regular trading hours, RTH. Okay, so we're going to see the gap, the difference between previous day's settlement price at 4:14 p.m. Eastern time to where we open at 9:30 Eastern time, the very next trading day. So it's not showing you all the fluctuations in price overnight in Asia, in London, and then before the new AM session at 9:30 Eastern time. So you have to be aware of that price action still, but you can't ignore regular trading hour structure, which is what we're showing here. Okay, so if you take a very close look at where we opened up from where we settled previous Thursday at 4:14 p.m. Eastern time, we have a very large premium gap. That opening price here does two things. Number one, it triggers initial desire to want to be a buyer, because a lot of retail traders just see the price being flashed on the screen and say, well, yeah, that's a strong opening. But what do we do after we open? That's what a professional perspective is, not where are we at in relationship from the previous day's close to today's open. That's retail. That perspective, that measurement of bullishness or bearishness is identified through that lens. But a professional sees it from where do we open at and how do we close based on that open. And you want to think about that for your sessions, not necessarily just limiting it to daily range in its entirety. You want to be thinking about from the beginning at 9:30 to say 11 o'clock in the morning Eastern time. So that's your AM session. Same thing for the afternoon. Where do we start trading at 1:30 p.m. Eastern time for that opening range for the PM session? What's that opening price? The very first tick at 1:30. Then where we close at 4 o'clock. That could be your entire afternoon range. And where we open versus where we close, that's the professional measurement of the lay of the land, how the market is delivered. So simply stated, we have a very high premium opening here. But if you're looking at regular trading hours, you're going to see that they opened it up above regular trading hours relative equal highs. So in here, we have Thursday's regular trading hours buy side liquidity. And now looking at this right there, this is your first presented fair value gap, because it's done a raid on previous regular trading hours relative equal highs. And now with that opening here, we measure the opening range gap to find the consequent encroachment of that. As soon as we get the opening price right there, boom, you know that you're looking for 70% likelihood it's going to pull back into that opening range gap, 50% of it. Okay, so that's important to understand. When we see this, it's almost as if you have x-ray vision and you can read what price is reaching for and how it's engaging liquidity from both the regular trading hours market structure and also incorporating the same ideas with the electronic trading hours market structure, which we'll look at in a moment. But this right here, that consequent encroachment is that level right there. So it comes up later on, hits it. If you look real close, there's going to be minor buy side liquidity rating here. So this white box is the opening range gap for the AM session. So that's 9:30 to 10 o'clock, that measurement. And we're looking for where we settled previously, which is here, and where we open. And that's what we're showing the depiction of that. Okay. So we're blending two elements there, time and price. And we're also blending in the elements of regular trading hours, time, and market structure, and electronic trading hours and market structure. So what do I mean by that? Well, before we do that, I want you to notice that we have all this run up in here without having the need to take out that low. I want you to take a look in this little area right in here and see if there's anything useful that you might see as, obviously for you, it's going to be hindsight, but for an educator's moment to point out something to observe before we get further into the video, inside this area in here, if you don't take this low out and you're expecting the market to break down, what might you consider in this little area in here? Pause the video.
All right, guys, pause this video and type in the comments what you see before I give my take in about 5 seconds. So pause the video right now and leave that comment. If you don't leave a comment, then it doesn't count. Okay, so obviously we want to aim for the sell side below this swing low. However, the market sometimes does not go to the external liquidity. So in this example here, we actually have a couple of things we can use to exit besides this swing low. If you look just above it, we have another swing low, and just below that, there is a fair value gap. So we have both external liquidity and internal sell side liquidity here. Of course, in hindsight, we can see price do exactly just that. But one more thing, if you take a projection from this high to this low and you project it down, -4 standard deviation should be around here. Or if you project from this high to this low, the previous low, it will get about -2 standard deviation around the same level, which lines up again with this fair value gap. Now, I don't think ICT will show projections, but that's another thing you can try to do and see if it lines up with any PD arrays when trying to decide on an exit.
Drop down to the 1 minute chart. Now I had this compressed and I'm showing it through electronic trading hours now. So I've toggled my ETH, RTH back to electronic trading hours. I have the range shown here that makes the opening range gap. That's that white shaded box here. If we're looking at how the market trades from regular trading hours and electronic trading hours, you have to look at the stops that are there. You have to look at how the market delivers to inefficiencies, from inefficiencies to liquidity, from liquidity to inefficiencies, and stripped down. Let's just say you were looking at just the electronic trading hours only, and you didn't even refer to regular trading hours. I teach you that going back from pre-market session, 7 o'clock in the morning Eastern time to 9:30 opening bell, that 90-minute window of time, that could be your entire trading canvas where you do all your work there and you don't care what it does after the opening bell. There's plenty of opportunities to do that. Or you want to use a session trading to give yourself a little bit of a buffer and then trade heavier handed after you get the opening range and the true understanding of where the market's going to go after 9:30 opening. That's a little bit more advanced. That's what I usually do when I'm running up the accounts. I'll do things like that. I'll build in a buffer right before the major session I'm looking to trade. And that might be the afternoon. It might be I'm not trading in the morning because FOMC rate announcement's coming out later in the afternoon. So I will do very, very little light-handed trading pre-session because I know usually the morning session is going to be quiet, lethargic, choppy. And then after the initial distribution of price higher or lower at the 2:30 conference when they're now going to listen to the Fed chairman speak, that's usually the real move. And because I've done something early in the day, I've patted myself out. I would be willing to risk 50 to 75% of whatever I earned in that light-handed trading to leverage into what I think is the real move in the afternoon. So these are some of the things that I like to do and how I use planned leverage and light-handed trading where I build a little buffer for the real big impactful event that I'm trying to actually trade that day or session. But if I take your attention back to some of the things I've taught, using the obvious pools of liquidity, they cannot hide it from you. Okay, you don't need level 2 data, you don't need volume profile, you don't need any of that stuff. Okay, you don't need none of those things. But it makes you feel and look intelligent in the eyes of other people. When they look at your chart, it seems scientific, but it's simplistically shown by looking at time first. So if we're looking at the 9:30 opening range, Eastern time for equities open, going back in time, what's the first thing you're going to run into? London sessions liquidity. Well, here you go. Here's London's low. What happens prior to that? Asia's session's low. So those are two levels that we would be looking for when we have the market opening up, trading above this short-term high here, and then bumping it right there at the open. So just think about that for a second, okay? We have a blending of regular trading hours and electronic trading hours to see kind of like an envelope, a barrier at which we want to see price reaching for obvious pools of liquidity that doesn't need level 2 data, is pointing to where was the high at, where was the low at in the Asian session, in the London session. And now we're building them for the morning session that can be used for the afternoon or lunch macro. So this little bump up here, taking out that high, that's something I pointed out to in one of my students' live streams. Dasha, you know her as Lumi Traders. So I shared that. I said I ran the buy stops here, and now I'm going to be looking for 21,360, and that's based on London low. Okay, so I have witnesses over there that'll corroborate and say, yeah, he did that, but without having the need to do that type of thing. I mean, obviously, I've been doing this enough now. If you've been following me, if you're a student, you know that there's no hindsight required. I'm pointing to these things. I just want you to look for these types of conditions, these setups, these parameters, so that way you can start to formulate a routine that you follow every single session. You're not trying to reinvent the wheel. You're not trying to complicate it. You're not trying to bring every tool, every aspect of whatever I've taught into every situation, because every situation doesn't warrant every PD array, every school of thought that ICT's ever codified. And that's you as a student, or that's someone that doesn't want to learn how to use this stuff. They just see all these tools, these concepts, these procedures, and they think, oh, who's going to do all that? Well, there's no application ever by me or a instruction by me to try to throw everything I have into every situation right now. Looking at a chart, you're not going to have every PD array there. That's why knowing all of them generally is a good thing, but you're going to specialize in one or two, and that's all you need. And your setup might not form that given moment, and you let it go, and you trust that you'll find another setup. Or, and this is my hope, that you'll learn a lot of the continuation patterns that I teach with PD arrays, like volume imbalances, mitigation blocks, institutional order flow entry drills, that type of thing. That's why it's beneficial for you to know, like month 4's content in my core content mentorship lessons. You can find that on the YouTube channel, where I'm teaching the PD array matrix and the general introduction to the basic PD arrays. Not all 81 of them, but just the most pertinent ones. I think that's going to be easy for the majority of all of you as retail traders, being able to see that in price action and how useful they are. So I want you to take a look at this. Buy side liquidity here, taken. Buy side liquidity here, taken. Buy side liquidity here, taken. And we're seeing this occur in electronic trading hours. That leads to that big pump up that keeps us above the relative equal highs in the regular trading hours. Remember, we're looking at electronic trading hours here, okay? So this is one of the things that new students with me, or those that maybe already trade but never know how to consider regular trading hours versus the effects of electronic trading hours market structure. You have to blend both of them. And if you think that's a complication, I'm sorry, but it's going to require a little bit of thought, okay? You're trading against the most elite minds in the financial world, markets, arena. You're literally up against juggernauts with billions and billions of dollars behind them, and complaining about how, this should be easier for me. Then I'm not your mentor. You need to go find somebody else, find somebody's moving average, crossover indicator, that type of stuff, and just do really, really good risk management, and you might be profitable. And I wish you good luck and God bless you if that's what you want to do. But I just don't think like that. I want to know what's going on. I want to know how I can formulate a plan that the algorithm will refer back to the same things I'm teaching you. Everything stems from time, delivery, and then price. It's time for the market to do something before price will do it. That's it. The only time it doesn't occur like that is when there's a geopolitical upset, some kind of thing that you didn't see, a terrorist attack, a bombing, a war breaks out, an assassination, a terrible earthquake rocks a specific area, anything of that nature that's an act of God. You just can't predict those types of things. So apart from those things occurring and manual intervention, the market's going to book by time-based delivery first, and it's going to refer to price when it's time to refer to price. That's what an algorithm does. That's what this price engine does. There is absolutely one algorithm on every instrument that is delivering price. It's not buying and selling pressure. It's this engine that keeps pushing, offering higher prices. No matter how many people want to sell it, that's going to keep ticking and keep ticking, keep ticking, offering higher prices. And because there's people always coming in at market orders, and because there's pending orders, there's always going to be a price that they can use. The book, you only need one contract to cause the price to create the candlestick at that high or low. You don't need big volume. The folks that believe in volume. So I don't look at those archaic tools and those reference points, because I know how liquidity is going to come in the marketplace. I know it. And you don't need any of these external tools. All you need is a chart, the open, high, low, and close, and what time is the high and that low formed. Asia session, London session, pre-market session, 7 o'clock to 9:30 open. And then you have the 9:30 to 11 o'clock, where's your liquidity in that, because that's your AM session. And then the lunch macro will pull against that. Even if it's going to stay consolidation, or if it's going to reverse or continue, it's going to go back into the range for that liquidity that was formed at 10 o'clock, going into whatever it has done during the lunch hours. It does this every day, folks. Every day it does that. And then you have the PM session, which will use the lunch macro liquidity and or the AM session liquidity. And that cycle repeats over and over and over again. They cannot hide it from you. They cannot cause any kind of distortion in your data. Okay, everybody is going to have the same price high and low across all the brokers, because you're trading in a real market. You're not trading a CFD. You're not trading in Forex, where every broker gets to mess around with the highs and the lows. That's what makes these markets better. They're a gentleman's market. They're not a cowboy that wants to ride like on a crypto market where everybody gets a chance to do stupid stuff. So I jawboned a little bit there. I apologize. But I want you to take a look at this area right in here. We're zoomed in now, and I want you to see all these highs here are just falling short of this area right in here, this SIBI, sell side balance, buy side inefficiency. Minor buy side liquidity here. The market stays in this consolidation. So at 9:30, we open, we hang around, bang around, bang around, bang around, and finally retrace back up. Because if it's going to go down, they're going to price in a premium, and they're going to take out some measure of buy side. And that's this area right here. Trades right up into that level, and then breaks, comes back up, breaks one more time, and in here, I'm looking for a short, because we're in the lower portions now of this SIBI. Add in the other, which I'll have in my charts in a second, but the way I teach first percent to fair value gap, this week I pointed out several of them, and you're instructed by me to always project them in the future. So in trading, you just toggle it, extend to the right. And if you do that and you label them, as you'll see mine in a moment, it helps you stay organized. But you don't have to have all these things on your chart that you're looking at every day, all day long. You should always have a naked chart, nothing on it, because it allows you to see things with a blank slate or a canvas that doesn't have any paint on it. It gives you a fresh perspective constantly. So throughout the day, throughout the morning session, the afternoon session, I'll take everything off my chart and look at price action like that. So that way I'm not marrying the idea, I'm not forcing my will in the marketplace, because by having all these annotations on the chart, if I'm making examples for you and I'm executing and taking live trades, these annotations are not necessarily on my chart when I'm trading, because I don't want to force that outcome on my end result expectations. And you can do that by dressing your chart a lot. And by managing the information that you're curating, taking all of these things, first presented fair value gaps, new week opening gaps, new day opening gaps. I have nothing on my chart, no reference at all to those there. Like I'm not looking at new week opening gaps or new day opening gaps in any of the things I'm showing you here today. All of those things add, but you don't have to apply it to every, well, not to every, to the chart you're looking at, your bellwether chart, the one you look at basically majority of the time throughout the trading sessions that you're trading. You want to have templates. You want to have things that you can toggle and refer back to periodically, like every couple of minutes. You can say, where are we at in regards to the last 5 new day opening gaps? Where are we at in regards to the last 5 new week opening gaps? Where are we in regards to the Asian session liquidity from earlier in the week, Monday or Tuesday or Wednesday? You want to constantly be referring to all those pools of liquidity, and you will start to see the rhyme and reason of what price is doing. But until you start keeping a log of all these things, you won't fully appreciate what I've been teaching all these years in front of you and in executing on it. My students executing on it. The fact that you can't identify any of it is because you're not annotating your chart and logging them and collecting them and then studying at the end of the week. Before the week opens up, you should have already spent about 30 minutes to a maximum of an hour reviewing where the turning points took place intra-week, intraday. What was the weekly high and the low? How did that relate to what the weekly chart and the monthly chart is suggesting? And you get closer to what the market's doing by doing things like that.
Okay, so I let him talk for quite a while. I don't really have anything to add, but he went over a lot of interesting things. I recommend rewinding and listening to it again to get all the little details. I did skip over some ranting about volume. Check out the original video if you want to listen to that, but here, this chart may look familiar. It's actually the trade example from last time when it was a silent video. You can check out my last video where I gave my own commentary as he's trading. And here you can see this 21,362 level is Friday's London low, which was not explained in the last video, but I guessed it was the previous day's low. Now focus in here. This is the 930 candle and it's the first presented fair value gap. Remember to include the volume imbalance up here, which will give you 50% of that fair value gap here at this blue line. Now, previously, I had incorrectly assumed it was the 931 candle, so I didn't understand why the previous video was called an advanced first presented fair value gap, but now I understand it's actually the 930 candle, which is not part of the normal first presented fair value gap rules. So that's why, combined with the regular trading hours liquidity, this is a more advanced concept.
All right, so this is your first presented fair value gap. And consequent encroachment of that gap is here. So you can see we traded up into it, bumping the buy side. Consequent encroachment of first presented fair value gap at 930. Breaks lower, comes back up, hits it one more time there. And we're staying outside of what? The upper half. That's order flow theory with my PD arrays. It's always like that. It's always like that. Let's break this down a little bit further. So as the market drops down in here, there's a fair value gap there. And then there's volume imbalance right here, separation between the bodies. So the market trades up into that and then breaks down, trading down into Friday's London sell side liquidity pool.
Okay, here, if you paid attention, he briefly showed a projection of negative 1.5 down here, and there was a negative 1 standard deviation right here below Friday's London sell side. Now, I'm not exactly sure where he's anchoring the projection though. It seems to be the high of that first presented fair value gap to, well, I don't know where the low is, maybe the body of this first swing low, or the high of whatever this pink fair value gap is. I went back in his video to look, but I'm not sure what this pink fair value gap is. I wish he would have elaborated more, but anyways, let's go ahead and continue.
Right, in the 1 minute chart here, you can see I've identified the Friday London session liquidity, Friday Asian session liquidity, and then Thursday's regular trading hours. And earlier in the video, I told you to look inside that low, and you'll see that there's a little fair value gap right there. It's a buy side amount, sell side inefficiency, and we traded right down into that. You see that? So what is this level here? If you measure the opening range high to low, and you run a negative 1.5 standard deviation on your fib, you'll get that projection that takes us below both London and Asia sessions liquidity right here. So that's the level. And it trades down to that inefficiency, but not needing to take out Thursday's low.
Okay, so he did explain it, and he did highlight this fair value gap that I mentioned previously when we paused the video. However, this is the second time I failed to understand why this is the opening range low. You know, shouldn't it be the low from 9:30 to 10 o'clock, which will be this one? You know, if you do a projection using the high in this low, -1 standard deviation would probably get you about the same level. I don't know, maybe it's me, I don't really study the opening range. If anyone understands this, please let me know in the comments.
So here is that zoomed in, that little fair value gap I was quizzing you on earlier in the beginning of the video. This is what you should have seen. And we don't need to see Thursday's regular trading hours sell side liquidity be taken. All right, so stripped down in a normal fashion, this is what my charts usually look like, and it looks like this when I'm doing the execution. When I'm showing it to you, here's the bump on the buy stops. Here's the opening range gap. First presented fair value gap. Inversion fair value gap. See this low here? That's the start of a new day. This is a first presented fair value gap at the start of the new day. Project that forward. You can see how it's being used here. And then they finally bump through it, leaves it, never comes back. That's a good thing. And then you have this sell side imbalance, buy side inefficiency here. Project that forward. And then here's the minor sell side liquidity that attacks. And then you have volume imbalances in here. And you can see all that, how that was used in the recorded execution. And then you have Tuesday's PM session first presented fair value gap. It draws down into that too. So look at the bodies respecting that. Think about that. It's interesting, isn't it? You're going to tell me that's buying and selling pressure. Everybody that doesn't follow what I teach somehow agreed to be buying and selling to afford the opening price and the closing prices of these two candles to reflect the respect of that Tuesday PM session first presented fair value gap. You're going to push real hard to make that argument. I'm going to laugh in your face. So we're going to moving in to a little bit more of the morning session here. We project that forward at fair value gap. Now we change its character from that of a sell side imbalance, buy side inefficiency, which is going to be used to sell off further to get down to our target. But now when the market has done our target, it's going to consolidate and trade above it. And now it changes its character. Its initial bearish character now becomes bullish. Look at respecting the consequent encroachment here, rallies back up into the actual first presented fair value gap at 9:30, falls short of going into consequent encroachment, comes right back down in fair value gap. You can do that on your own with sell side. Hits it, rallies, comes back up in, volume of balance, rally, and then we get back up inside of the first presented fair value gap. You're going to want to put your gradient levels in there. So in other words, you're going to use the high, upper quadrant, consequent encroachment, which is midpoint, lower quadrant, and the low. Put that on. I just didn't want to have it on here because it's too busy, but you can see that that's what's occurring here. It trades up, comes down to lower quadrant, consequent encroachment, upper quadrant, and you're seeing the beginnings of the afternoon session in here. But this is the morning AM session, opening range gap, first presented fair value gap. Huge, lots of things in there. Sounds like word salad, but this is what separates the lazy from the people that really want to understand how to manage risk, know when setups are going to form, never fall victim to fear of missing out, never fearing a shortage on supply of trades. Okay, these things happen every single day. What do you think the professionals are doing? The people that aren't teaching like I am, they're out there in these big institutions. What do you think they're doing? You think they're out there guessing all the time something different every day? No, they have models. They stick to rules. And I'm giving you time and price analysis. That way you can tap into these setups that form every single day. They cannot hide it from you. You don't need extra, level 2 institutional tools and all this other stuff. They want to try to sell you these gimmicks. They're all used against you. All of them. The things I'm teaching you, it is the market. Right here's the afternoon. And you can see that is the first presented fair value gap for the PM session between 1:30 and 2 o'clock Eastern time. The market trades down to the low of the actual AM first presented fair value gap, rallies back above, consequent encroachment, and then look how it accumulates inside of the first presented fair value gap between 1:30 and 2 o'clock. It helps you identify the actual fair value gaps that's going to help you know which one to trust. A lot of you don't realize what I've done. Okay, I've pulled back the veil and I'm teaching you how to never fall victim to picking the wrong fair value gap.
Alright, so this was a great lecture. He answered a lot of questions I had from the previous video. I know this one was pretty long, but generally his longer ones contain the most valuable information. So I'm always happy to listen through the long ones. If there were things you were confused on, I encourage you to go back and rewatch it slowly. But don't just watch the video, make sure you take notes on these things. On stuff that resonate with you. You don't have to take on everything, but the things that really matter, take notes. For example, on the higher time frame or any dealing range for that matter, don't expect retracement once price is past 50% of the range. In fact, it's more likely to hit external liquidity if we don't have much retracement. So that's one key takeaway that I was able to take away from this. I want to know what insights were you able to take away. Let me know in the comments. Also, please give this video a like and subscribe as I cover more ICT lectures. But until next time, traders, safe trading.